was taken as almost axiomatic 6 months or a year ago that at some point the Chinese economy would surpass the American economy in terms of total GDP at market exchange rates. That's now much less clear.
The last 10 years certainly have been bad, very bad for the bank, but you look at the situation today, trades at less than a third of book value.
No.
It still has a robust private wealth business. All they have to do is prevent the investment bank from losing money and get it back to some sort of growth.
With high interest rates and high inflation, we are still going strong. Also with the prices of energy skyrocketing, especially in Europe, we have not seen any slowdown yet.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Sentiment restrained, stocks in the red as investors look ahead to Jackson Hole. China cuts its benchmark lending rate to support the economy. The Credit Suisse shuffle, while the embattled Swiss lender brings in a new finance chief, pushing ahead with its major revamp, plus summer of discontent. Strikes at the UK's biggest container port are set to upend supply chains. We're live on the ground in Felixstowe. Now, first thing is first, so let's check on the markets. This is the picture overall. A lot of focus, of course, on that all-important Jackson Hole speech by Jay Powell. That will be on Friday. Stocks in Europe retreating. U.S. futures also down. Again, because of the Fed's commitment to tighter monetary settings, that's restraining investor sentiment. European stocks down 1%. Look at that euro dollar 0.9998. Now, the last time we had, I think, 9995 was in July, and we hadn't seen that for over a decade. This is a story of dollar strength, yes, but also of euro weakness because of all of the price swings when it comes to energy, certainly everywhere in Europe, but also especially in Germany. The S&P 500 futures down 1%, then Bitcoin 21,052. Now, if we look at the European map, and again, the euro dollar is extremely significant, especially for further ECB monetary policy. So let's look at the map. I think we have it. There you go. You can see a sea of red with a lot of course, the things we're looking at, including some of the sectors. So look out for the difference between what we're seeing in the DAX, for example, in Germany, and what we're seeing here in the UK. Now, let's discuss Jackson Hole. Central bank watchers will be following the Kansas City Fed's economic symposium this week for clues on the U.S. rate path. Currently, there's a standoff resulting from conflicting U.S. economic data. On the one hand, we had a strong jobs report. On the other, a cooler than expected inflation print. Well, joining us now to discuss all of this is Susanna Streeter, Senior Investment and Markets Analyst at Hargreaves Lansdown. We also have Phil Serafino, Bloomberg Senior Editor for EMEA Equity. So thank you both for joining us. Susanna, thank you so much, and welcome to the studio.
Thank you very much. It's great to be here.
So what kind of equities are you buying, if anything, ahead of Jackson Hole?
I think it's a very difficult time right now. So much uncertainty. I think that's reflected what we're seeing right now in the equity markets. A bit of treading water going on, trying to work out what the direction of travel will be. You mentioned, of course, all that conflicting data. And I think there really was a sense that because that inflation print came in a little bit lower than expected, there would be this easing off of this monetary tightening. Unfortunately, I think that certainly has been over-optimistic, and that's been reinforced by comments we've had from some Fed policymakers. So certainly, for now,
really
I think
important that Jackson Hole, Jay Powell.
Oh
right,
yeah,
on
absolutely.
Friday.
Yeah, really important, because I think there's a real need for some more clarity, really, on what we should expect in the time ahead, at a time when, of course, the cost of living crisis is biting for so many people, not just here in the UK, it's particularly bad, but also in the States as well. And you've got those retail latest results showing that actually even middle classes are trading down.
So, Phil, what are you expecting from Jackson Hole?
Well, I think Susanna's right. The market has been treading water. And, you know, it's unclear what kind of signals the Fed is going to give, Jerome Powell is going to give at that meeting. But investors want some sort of signal. You know, the market is priced in sort of the perfect scenario where the Fed doesn't go too far raising interest rates. I mean, investors are going to be hanging on every word. What is the tone? And so that is the first big event for the market. The people are trying to figure out if the rally is for real, and the Fed will be a big sign. And then right after that, you have some economic data in early September. There's a jobs report the first Friday of September, and then there's CPI in the middle of the month, leading up to the Fed, I think on the 21st of September. So, there's a lot riding now for the market on these next couple of weeks, starting with Jackson Hole.
Yeah, a lot will be riding. What's your take, Phil? And then we'll get back to Susanna on the overall equities picture. But what's your take on earnings? I know they're a little bit backward looking, but can we be really in for crunch time the next quarter?
I mean, the earnings in the second quarter, the market was generally very pleased. Companies look like they're managing the inflationary pressures pretty well. Demand does not show signs of hugely tailing off. Again, it is a snapshot. The expectations are that estimates are going to have to come down given the fact that interest rates have gone up so much. That's going to feed through to the economy. It's going to curb consumption, certainly by consumers. So the question is, do earnings hold up well enough over the next couple of quarters to keep the market up at these levels and even send it higher?
Do you worry, Susanna, about second round effects, of course, for energy that we haven't really even looked at yet?
Yeah, absolutely. And of course, there is a lot of talk about the potential impact of the Iran nuclear deal and how that's already been priced in to some extent, partly contributing to the drop in crude prices that we've seen, but obviously they've been mainly pushed down about fears about the global downturn. But of course, I'm not expecting any kind of deal to take place before the November midterms. So I think, though, that's going to be pushed into next year. Certainly from the European side, there's a lot being pushed there, given the energy crisis unfolding right across Europe. They really need to try and find some way of ensuring that crude prices aren't as onerous, such as gas prices are. So I think that is going to play out in the next few months as well. So there could be certainly some weakness going forward.
And so what does it mean? So when you look at your portfolio, what do you buy with conviction? If anything.
I think it's very difficult. I mean, this is a time when really you need to make sure that you have a very diversified portfolio and no single major big plays, I think, because it's such an uncertain outlook. And I think looking across other asset classes as well to try and give your portfolio a bit of extra ballast, really. So I think certainly when it comes to consumer focused stocks, I think, as Phil was indicating as well, we may have seen some pretty good earnings, but actually I think there's going to be much more weakness to come. And although there was optimism actually surrounding those Walmart results, in fact, there was quite a lot of weakness in those figures because there's so much discounting having to be undertaken at the big retailers, and we are getting this trading down. Consumers simply can't afford those discretionary items. Research, particularly for the UK, Hargreaves Lansdown has undertaken financial resilience research with Oxford Economics, shows that next year only 1 in 10 people will actually have the money left over at the end of the month to make those discretionary purchases. And I don't think that's been fully reflected.
That's really interesting. What do you not see fully reflected, Phil, that we could see as we get into the winter months? I don't know whether it's credit card bills or whether it's that pricing power that so far a lot of retailers have been able to pass on.
Yeah, I think just the general inflationary environment is really going to weigh on consumers. Susanna was talking about gas prices. Europe is facing up to a fairly tough winter on the energy supply front, and there's no sign that prices are going to come down too much soon. And, it's pretty interesting that consumer discretionary stocks have done very well since the market low in June. So investors are sort of assuming that none of those pressures are going to start to bite on consumers. And, it's going to be interesting to see whether the market sort of can thread that needle.
Right.
A lot of things have to break right for consumers to do well over the next 6 months.
Phil and Susanna, thank you so much. Susanna Streeter, they're a senior investment and markets analyst at Hargreaves Lansdown, stays with us, and thanks to our Phil Serafino in Paris. Now, coming up, the summer of discontent continues as workers go on strike at the UK's busiest port. We'll be live on the ground, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, this is what we're looking at in terms of euro-dollar. It did touch parity, below parity actually, something that we've been watching very closely for quite some time. Let's also look at Chinese main interest rates tool. It's a little bit geeky, and that's what we like, especially on a Monday morning at 9:12 UK time. Now, Chinese banks have lowered their benchmark lending rates. The authorities have stepped up support for the property market with additional loans. It's all part of a government-guided attempt at alleviating a worsening housing crisis and bolstering borrowing demand. Now, it did little to actually lift a risk-off sentiment on markets. Investors now counting down the Jackson Hole gathering of central bankers later this week, where they will be on the lookout for any hints about the Fed's tightening plans. Well, we're back with Susanna Streeter, Senior Investments and Markets Analyst at Hargreaves Lansdown. We have so much to talk about, Susanna. We're all over the place. We're looking at like really geeky Chinese stuff to give us an indication of what policymakers can do, but we also need to talk about euro-dollar parity and the fact that it broke through that. First of all, on China, can they support the world economy?
Well, it's interesting because it's unleashed this round of stimulus in lowering this key lending rate. And in previous attempts, when there has been this kind of level of stimulus, it has, I think, lifted the markets much more, an expectation that China will kind of resume its powerhouse status. But that's certainly happened. And I think that's an indication that the market does expect this underlying weakness in China to continue, partly because of the really struggling property sector with Evergrande and other major corporations still really teetering despite all the efforts to try and kind of buy off chunks, for example. And also, interestingly, I saw like Burberry share price hadn't really moved much. Of course, Burberry highly reliant on consumer sentiment in China as well. So I think certainly for now that uncertainty on China will continue.
But I mean, investors just want more, right, from policymakers in terms of support to the economy. Last week or 10 days ago, we had that token support. Are you expecting them to do much more?
I think they will do much more, yes, certainly going forward. And we've seen that in the past. I certainly do think that we'll continue to see that in a kind of incremental approach going forward.
All right, I have a million questions. We did have a really great China data start. I think it's like 2 standard deviations in terms of what we've seen in terms of ratio. Let me get on to the UK. I mean, I don't know what to do with the UK right now. We've seen some, great stories, including from our Valerie Teitel saying a lot of the currencies are actually behaving like emerging markets currencies.
Well, I think the summer of sweltering summer of strikes is turning into a very awful autumn and looks set to be a bit of a winter of woe, certainly for the UK, because we ain't seen nothing yet in terms of the rises in energy bills, up to £3,500 in the autumn. Forecast it could rise to £6,000. Now, that is so high. So many households are going to really struggle. And that is going to have a real impact, I think, on earnings, the consumer sector in particular, going forward. I think it's going to be so tough. And, of course, we still have this uncertainty surrounding energy security, not just in the UK, but across Europe as well, which is partly why, you mentioned the euro-dollar parity. I think that's why you're seeing continued weakness in the Eurozone because of fears about whether Germany can cope if gas supplies are turned down even further.
But Susanna, when you look at the UK, and we're talking about energy poverty, right? And what you're pointing to is households not being able to repay bills. I mean, it's a scenario that has been highlighted by the Bank of England. Is it going to be worse than what they think? And again, what does it mean for an investor?
I think the danger is we've got this groundswell, this campaign to ditch the direct debits. So more than 1 million people vowing not to pay their direct debits because they can't afford their energy bills. Now, that could have a knock-on effect in terms of credit risk. That could compound the issue because they have to pay more for any kind of borrowing going forward. So this individual crisis could end up causing much further pain, deeper pain going forward.
So as an investor, do you not touch the UK or do you wait and see what the winter
certainly, FTSE 100 has proved remarkably resilient because of its makeup, energy financials, for example. There will be, I think, certain companies that are going to fare worse than others, but there is still, underlying strengths in some. You've got the health tech sector, for example, and the health sector in terms of, say, PHP Properties, leasing doctors and surgeries, and there is going to be some stocks that are going to be resilient. And I think perhaps searching for income-generating stocks might be the way ahead to find that stability in the UK market.
Susanna, thank you so much for joining us today. Susanna Streeter, their Senior Investment and Markets Analyst at Hargreaves Lansdowne. Now, let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. About 2,000 dockers at the Port of Felixstowe in eastern England have started an 8-day strike, halting the flow of goods through the UK's largest container gateway. Workers are unhappy at the port owner's offer of an average pay rise of some 7%. Felixstowe handles about a third of Britain's total container volume. Now, a senior diplomat has reported to say that Russia does not see a diplomatic solution to the war in Ukraine and expects a long battle. Meanwhile, Moscow is investigating a car bomb that killed the daughter of a Russian nationalist who had herself been sanctioned by both the US and the UK. The bombing comes ahead of this week's 6-month anniversary of Putin's invasion of Ukraine. In China, the province of Sichuan is extending industrial power cuts as a heatwave persists. Officials say blistering temperatures and surging demand for air conditioning have caused gaps in generation. Companies, including Toyota, have already suspended operations in the region for several days. The power shortage adds another challenge to companies already contending with the country's COVID-0 strategy. And Singapore is repealing a colonial-era law that criminalizes sex between men. The country's Prime Minister says removing the legal ban is the right thing to do and something that most Singaporeans will now accept. Lee stopped short of recognizing same-sex unions, adding that the constitution will be amended to protect the definition of marriage as being between a man and a woman. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thanks so much, Leanne. Coming up, but turning to nuclear as the energy crisis is set to deepen, Germany is considering alternatives to cover the gap left by Russian gas cuts. More on that next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition, and Francine Lacqua here in London. Now let's focus on Germany now. And the country may not be able to replace all of its imports of Russian natural gas this winter and might actually have to resort to nuclear power to plug part of the gap. Europe is in the middle of its worst energy crisis for decades, of course, which has fueled inflation and put nations at the brink of a recession. Now that's forcing politicians to look at all alternative available. Now with Europe in the middle of this crisis, let's go straight to Birgit Jenin, who's our bureau chief over in Berlin. Birgit, great to have you on the program yet again. First of all, what kind of alternatives has Germany found?
Well, the problem is that Germany has not yet found really an alternative. They are in talks with Canada. They have been in talks with Qatar and in talks with Norway. And all of these government and countries say that at the moment they're not ready really to supply extra energy. Norway can't, is at the maximum of its gas production. Canada has problems domestically because it would mean a turnaround in their ecological policy, and Qatar is really playing hardball, we hear, sort of, with people who are negotiating with them. So really it is a problem, and therefore the government is really looking at any way how to basically produce some more energy for the winter. And for that reason, they are looking at something that they have never considered in the past, keeping sort of 3 nuclear plants running at least for a while. And they are doing at the moment research, which the result is expected at the end of the month.
So, Birgit, what does it mean for the cost of living? How tough is it for German households right now?
We do obviously see that already the prices are rising, but I think the consumers haven't yet actually experienced the real brunt of it. This is going to come over the next month when basically the surcharge which is being introduced is going to hit. It goes up to 500 euros per household, which is a lot for particular low-income earners as well. So on top, there are already the existing energy price rises. So it really hits particularly Scholz's electorate, and that is likely to become an issue, a political political issue for him also over the coming month.
Yeah, and his popularity, Birgit, is really waning. Are you surprised at how fast it's waning?
I do think it was expected. We do see massive changes going through in Germany. I mean, and even before the election, he actually had also very often very low popularity rates. So really that there was the risk that whenever there is a crisis in Germany, that maybe the population, the electorate is going to look at alternatives and is looking at the CDU, especially at the moment. That was to be expected. But what it means for Scholz is really that he now has to make sure that his own party is staying together, because if not, then he really needs to turn inwards and cannot play the foreign policy role he has been playing so far.
Certainly. Birgit, thank you so much. Birgit Jennen there from Berlin. This is Bloomberg. Sentiment restrained, stocks in the red as investors look ahead to Jackson Hole. China cut its benchmark lending rate to support the economy. Well, the Credit Suisse shuffle, the embattled Swiss lender brings in a new finance chief, pushing ahead with its major revamp. Plus, summer of discontent, strikes at the UK's biggest container port are set to upend supply chains. We're live on the ground in Felixstowe. Well, good morning and welcome to Bloomberg Surveillance Early Edition, everyone. I'm Francine Lacqua here in London. Now, Britain's summer has already been punctuated by scenes of travel chaos, and there's more to come. Workers at the country's largest container shipping port, Felixstowe, have joined the list of those on strike. Now, for more, we're joined by Lizzie Burden, who's in Felixstowe for us. Lizzie, what a shot behind you. I mean, I don't know how many containers you can count, but it really captures the imagination of so many people around us. How will this disrupt trade?
Well, Francine, about 4 million containers pass through this port every year. So that gives you an idea of the scale of the trade that happens here. And this is the UK's biggest container port. Now, 2,000 workers are striking for 8 days. It's day 2 over this dispute on pay because we've got double-digit inflation in the UK and the port isn't offering that in terms of the pay rise to its workers. In terms of the disruption, the Russell Group says about $800 million worth of trade will be affected. It's lots of clothing, furniture, electronics, just as retailers are gearing up for Christmas. Flexport says it's going to take 24 days to clear the backlog of cargo. But the port says they've been through COVID, they've been through Brexit, they're going to be able to mitigate this disruption, but really they're not going to know how bad it'll be until they see how many workers cross the picket line.
So how long are we expecting the strikes to last, Lizzie, and what's the likely economic impact of that?
Well, speaking to workers in the area, it's incredibly difficult to decide not to go to work when it is a cost of living crisis. They're giving up their full wages. And so the port will be hoping that many of them crumble, cross the picket line and the strike breaks down. It's difficult to tell what's going on in the negotiations behind the scenes. But of course, it isn't just Felixstowe dockers who are striking. It's also the Liverpool dockers. It's also transport workers, postal workers, barristers. And so the risk is that the unions add to the wage price spiral that they're trying to shield their workers from in terms of the inflationary impact. But speaking to port officials here, they're very frustrated because they feel like they've been targeted by the unions to send a message when it comes to employers around the country in terms of giving bigger pay rises because of the crisis.
Lizzie, thank you so much. Lizzie Burden there in picturesque Felixstowe, and you can hear the seagulls in the background. Now we're joined by Richard Ballantyne. He's Chief Executive of the British Ports Association. Richard, thank you so much for joining us. When are you expecting this to last and still? How many more strikes for how many days?
Well, hello, and thanks for inviting me on, and sorry that it's in these circumstances that I'm asked to comment. I think, in short, we don't know. I mean, obviously, this particular strike is scheduled for 7 days, but there is a possibility that there could be further strike action, although that is a matter for the union, of course, who'll be in discussion with the employers of Felixstowe.
Richard, what does this mean for the overall economic activity in the UK? How much disruption are you expecting from the strikes called so far?
Yes, it is a kind of issue for the logistics industry and the freight industry and the shipping sector here in the UK. As Lizzie mentioned, Felixstowe is the UK's largest container port, but we do have other ports, so they'll help to pick up some of that slack. Freight will be rerouted through places like Southampton and London and elsewhere, etc. The ships, that is more difficult. So I would imagine that those vessels might be less fully loaded, but they will be waiting to come into Harwich and Felixstowe as they normally do, and then turning around, continuing their journeys. The issue is if you do reroute freight away from its traditional travel plans, etc., there will be a cost, and those costs will be passed on to importers, traders, and potentially ultimately consumers.
How much, Richard, of that cost? Do you have any kind of ballpark idea of how much more expensive this means for the workings of British ports, and how much of that is not only put to some of the consumers, but also some of the companies using your services?
No, unfortunately, that would be a question better suited to the wider logistics industry. I saw the Russell Group study previously, which seemed quite extreme, I have to say. But they obviously have worked out their numbers using their own formulas, etc. So I think it's a question better suited for them and people in the logistics industry.
Richard, give me a sense of how bad it is right at the moment for some of the port workers. Like, what are you looking at for the next 6 months? So how much are you expecting energy bills to go up? Like, what kind of metrics or numbers are you looking at?
Well, we're just like the rest of the population here in the UK. We're watching what politicians say. We're watching what energy companies say. And we are looking at those increased bills just as everyone is. And of course, port companies will be facing increased costs as well, not just the employees. But, do sympathise with those employees. I think it'd be wrong for me to get drawn into the discussion between Felixstowe and its own workers. That's a matter for them to alleviate, to sort out. I don't represent either party, so I think it's better for me not to be drawn into that debate specifically.
Right, but of course, I mean, the worry is that this upends some of the supply chains. I don't know whether you've also had discussions about what it means for insurance, for example, things like that. Like, what do you see us looking at in terms of British ports mid-September?
Well, everybody will be affected by the cost of living crisis, and you mentioned insurance and the financial services sector. I think it's safe to say a lot of the industries here in the UK will be looking at the impacts of inflation and the cost of living crisis, etc. So I would say it's more of the same to come. I'm not sure about strike action. Some ports have already negotiated deals earlier this year. Others will be working towards the end of the year. So we have to just wait and see how far the impact is across the ports industry. But we do have a very diverse and varied ports industry here in the UK with a number of different ports and operators. So it is a big sector for us here.
Richard, thanks so much. Richard Ballantyne there, Chief Executive of the British Ports Association. Now, we're also joined by Josie Dent, Managing Economist at the Centre for Economics and Business Research. Thank you, Josie, for joining us. We're looking at some of the supply chain disruptions. Of course, we're in Felixstowe, one of the biggest. I mean, I think Lizzie was saying some 4 million containers are shipped in and out every year. How much of an impact will this have on the UK economy?
So we can look at this from a few different angles. Of course, we have the immediate supply chain issues of supermarkets, retailers, all sorts of businesses not being able to get the produce they need right now, which will have knock-on effects on their supply chains if they don't have the inputs they need for their production. And then we have the element of the negotiated pay rise. All that workers are asking for is an inflationary matching increase in wages. But the concern across the UK with these strikes, with industrial action, is that we'll end up with some kind of wage price spiral where wages increase to match inflation, and then that causes inflation to increase itself through higher demand. And And then if we see knock-on impacts in terms of higher prices, because as we discussed earlier, ships have to be rerouted, and that costs more money, then we are seeing a direct inflationary impact. And so this, yeah.
Josie, give me a sense of the estimate. So with every, we're looking at rail strikes, we're looking at supply chain, of course, disruption because of port strikes. With every day of strike, how do you model how much of a hit the economy has?
So, I mean, if we turn to rail strikes, we have modeled a cost estimate for that. And for the rail strikes last week, the 3 days that we saw, we estimated that will cost the UK economy £65.3 million. And that's about a 0.01 percentage point decrease of the Q3 growth figure that we're forecasting. So it's substantial enough to affect overall growth, but not in a major way. Similarly, these port strikes will have an effect that will be in the multi-millions. We haven't yet estimated it. It's quite difficult to do, especially with a lot of uncertainty currently about how long this strike will last. But it will be substantial, especially if it leads to further price increases, which leads to further inflation, which has knock-on impacts on the cost of living crisis, which is the main factor having downwards pressure on the UK economy and UK growth right now.
So, Josie, at some point, there's what of course economists call a wage price spiral, where it's completely out of control because everyone's asking for a wage increase to match up with the cost of living. Are we there yet?
I wouldn't say we're there yet, no. I mean, the latest labour market data shows that there's around a 3% real wage contraction for the average worker. So wages are not growing as quickly as inflation. And that is, of course, why we have a cost of living crisis. The UK in general is not that unionised. Most people can't strike. No. And so most people are actually just experiencing slower wage growth than inflation. And it's a few different industries that have striked. But for the most part, people aren't seeing wages increase as fast as inflation. It's when this becomes a longer term issue with inflation, if it stays high for a very long time, then we could see that kind of spiral.
Josie, how problematic is weaker pound?
So that itself can be a source of inflation and is a big concern for the Bank of England at the moment. With a weak pound, imported products become more expensive, and we do import a lot in the UK. And so if the pound becomes weaker and weaker, then that will drive up the prices of many different goods that we import from other countries. And so that's a reason for the Bank of England to continue increasing interest rates, not just to affect demand in this country, which then influences inflation, but to influence global forex exchange, and so that we don't see the pound depreciate too much versus countries that we're importing from.
Josie, thank you so much. Josie, they're managing economist at the Center for Economics and Business Research. Now, coming up, we focus on Credit Suisse as the bank names a new CFO, and staff are also anticipating deep cuts from the latest emergency restructuring. While we focus in on the troubled Swiss lender, that's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance early edition. I'm Francine Lacqua here in London. Now, Credit Suisse has continued its shakeup at the top management, introducing Deutsche Bank's Dixit Joshi as its new CFO while promoting a new chief operating officer. Well, today's Big Take takes a deep dive into the Swiss lender's emergency restructuring, which also likely delivered deep cuts as well, potentially signaling the end of the lender's ambitions to be a Wall Street titan. Now, well, David Harrow of Harris Associates told us last week it might not be all doom and gloom for Credit Suisse.
This has been a problem child. We've owned this bank literally since the early 2001. And the first 10 years was a very good holding. I mean, it literally went from 20 to 60 or 70. Now, what we should have done is just sold it and that's it. But of course, during the financial crisis, they actually performed better than most other banks. And we increased our position again and had a very, very poor decade holding Credit Suisse as they've kind of hobbled from one crisis to the next. So what's the situation today? The last 10 years certainly have been bad, very bad for the bank, but you look at the situation today, trades at less than a third of book value.
Yeah.
It still has a robust private wealth business. I mean, they have 4 businesses, one of which is absorbing the profits of all the other 3. And all they have to do, really, it sounds simple, but all they have to do is prevent the investment bank from losing money and get it back to some sort of growth.
What would you do with it? Would you spin it off?
If they cannot fix it, if they cannot find a way for the investment bank to earn through cycle returns, they have to do something with it. Whether it's spin it, sell it, merge it. But at this stage, the price of Credit Suisse stock assumes roughly a 10 to 15 billion negative on the investment bank. And if they could repair the investment bank, make it such that it can earn through cycle profits, clearly it's worth more than negative 15 billion.
David, how much time should they try and fix it before they sell it, or spin it off, or do something with it?
Well, certainly in the next year or two, this has to be decided, but you can't keep doing the same thing as they've been doing over the last decade and get 0 results. They have to put an end to it. At some point, they either have to fix it or to look for other options.
Well, that was David Hare of Harris Associates that has around 10% of Credit Suisse, the largest shareholder by far. Now, joining us now is Bloomberg's Miriam Balazu in Zurich. Miriam, how big of a shakeup of the investment bank are we actually expecting?
Well, Francine, I think it will be a significant change that is coming for the IB here. It will be significantly diminished. They are currently looking at all options. Everything's on the table. But we're hearing that in extreme scenarios, it could get to 2/3 of the banks getting torched. So quite a change.
That's a lot. So how quickly can we expect that, Miriam?
Well, it's still undecided. The timing's not extra clear. However, the bank has indicated that they'll give some sort of clarity on how it's likely to look like by the end of Q3. So by the end of October, we should have a bit more clarity over how the shakeup's likely to look like.
So, Miriam, through all of your great reporting, what do you find most surprising, actually, with Credit Suisse? That it can attract still top talent, or that it's just going to not want to become a Wall Street titan when it comes to the investment bank?
I think it's still, IB is still at the core of the company, and just looking at Credit Suisse's history for investment banking, just a decade ago, they were in top 5 competing against Wall Street. And I think this is something that's still kind of paramount to the bank. However, we cannot just ignore the fact that it's very hard to attract talent just broadly across Wall Street, but let alone with the situation that Credit Suisse is currently in. And obviously, talent retention's been a big topic, and particularly the compensation package they've been handed out to a lot of their senior bankers just to retain talent. And I think this is going to be the biggest challenge for the bank this year, because no matter how big the bonuses are, really the reputational damage will start to kind of trickle down to all of the people within the banks. So I think this is the main challenge for the bank, retaining their core staff and also just providing some form of stability. We've seen new management changes again today. So.
Yeah, it certainly feels like that will definitely be their biggest challenge. Miriam, thank you so much. Miriam Balazu there in Zurich. Now, you can read more online around the terminal by typing NI Big Take. Now, coming up, we'll bring you full coverage of all the news from Jackson Hole, that big speech, of course, on Friday by Jay Powell. We also get euro-dollar touching parity, below parity. What happens next for euro-dollar? This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Garrett. Hi, Leanne.
Hi, Francine. Chinese banks have lowered their benchmark lending rate while authorities stepped up support for the property market with additional loans. The 5-year loan prime rate to reference for mortgages was reduced by 15 basis points to 4.3% after being cut by the same amount in May. This as Beijing battles a worsening housing crisis. It's reported members of the UK's Criminal Bar Association have voted overwhelmingly to begin permanent strike action from next month. Court cases have already been disrupted in the pay dispute by criminal lawyers. A permanent strike could see legal cases postponed or even collapsing. United Health, Amazon, CVS Health and Option Care Health are said to be among the bidders for US company Signify Health. Sources tell Bloomberg that United Health has submitted the biggest bid in excess of $30 a share, while Amazon's offer is just close behind that. Signify is holding a board meeting today to discuss those offers. And the debut of the prequel to Game of Thrones has overwhelmed the HBO Max streaming service in the US. More than 3,000 outages were reported across the platform at 9 p.m. New York time. Just as The House of Dragon was released, the new series premiered more than 3 years after the last episode of Game of Thrones, which drew more than 19 million viewers. And that's your Bloomberg Business Flash. Francine.
I will 100% watch that. Just because it's crashed, Leanne. When it crashes, it means it's good. It's like going into a busy restaurant. You never go into an empty restaurant, even if it means queuing for like 2 hours.
Well, Francine, when Stranger Things debuted on Netflix, that also crashed. I've never watched Game of Thrones, but I think I should now because it crashed. Like you said, it just draws attention to the whole series, doesn't it?
It certainly doesn't. There was also our Sarah Rappaport wrote a great review, which got everyone quite excited in the newsroom. Leanne Garren's there with your top stories. Thank you so much. If you look at European stocks, but also U.S. futures, a little bit of a downward movement. That this is as they watch to Jackson Hole, that all-important speech by Jay Powell. That's on Friday. So stocks in Europe definitely retreating. I think we have the board up. If we do, we can bring it up. There you go. Now, we also look at euro dollar, one of the biggest or the easiest way, I guess, to look at some of the angst that we're seeing out there. The dollar spot climbing to a 5-week high. Euro, quite a lot of pressure for euro because of what we're seeing with gas price and energy prices in Germany. Now, the latest MLive Pulse survey also suggests that stocks and bonds are set to tumble once more, even though inflation has likely peaked. A Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz in New York. Anna Edwards back in London. This is Bloomberg.
The U.S. doesn't really need to be on an improving growth trajectory. All that needs to happen for the dollar to strengthen is for the rest of the world to do poorly.
I think we're going to remain strong at least for the next 6 months. If you look at how the market is evolving, it's trying to build a sense of confidence.
When we look at the economic conditions and the market conditions in front of us, it leads us to a more cautious place.
It's not really the time to be taking big, absolute directional bets.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. China tries to fix a worsening housing crisis. Banks lower their benchmark lending rates while the government steps up support for the property markets. Walkout. 2,000 dock workers began an 8-day strike at the UK's busiest container port. They rejected a contract offer as inadequate. And a shake-up at Credit Suisse. There will be a new CFO and operations chief. All this as the Swiss lender prepares for a major restructuring of its struggling investment bank. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz in New York. Matt Miller is off today. And Kailey, I can report nothing but deteriorating sentiments the longer the session continues here in Europe.
Yeah, and it has started really in the Asian trading session overnight, Anna, in which basically every single equity benchmark was lower, the one exception being China, which I'll mention in just a moment. But clearly, risk-off sentiment is prevailing. The MSCI Asia Pacific Index was down for a third day in a row, losses of a little more than 0.5%. But as I said, China the exception after those banks cut the 5-year and 1-year loan prime rates, and really additional support coming in for the property sector in the form of loans. So that raised Chinese property stocks in particular, which gained about 1% overnight. What's interesting, though, is that as China eases policy, basically every other central bank is tightening policy, and that includes New Zealand, where the central bank overnight said they may need to raise rates to 4.25% in order to rein in inflation. And you saw an immediate reaction in the New Zealand bond market, that 10-year yield climbing 14 basis points to right at that 370 level. And finally, in foreign exchange, the big underperformer in Asia on the day is the South Korean won, actually hitting a fresh 13-year low against the U.S. dollar, trading right just south of 1340. That in part is due to weak trade data, but also it's just that basically every single Asian currency, or really every currency across the board, is weaker against the dollar today. Creedy, really speaks to the risk-off tone in these markets.
Yeah, but that dollar strength, I think, is really what you're starting to see cross-asset, at least here stateside. Real specifically, when you're looking at the futures, we were talking about that deteriorating sentiment in Asia and Europe. Well, showing up in the United States as well in the futures action, but a lot of it, once again, that inverse correlation between the dollar and the stock market, it is still strong. So keep an eye on that. It's not just about the currencies, not just about the commodities. It is actively infecting just how much kind of courage investors have to hop into the U.S. market in a risk-off market. Remember, the U.S. tends to outperform, but not in the face of that stronger dollar. So, of course, we see futures down about 1.2%. And the U.S. 10-year really unchanged here at 297. But if you look at that intraday volatility, that's what you want to keep an eye on, because really you have seen a little bit of choppy action throughout that Asia session. The dollar, like I said, already stronger. But when we talk about risk-off, we got to talk about Bitcoin. That risk-off sentiment really magnified through that cryptocurrency, Anna.
Yeah, risk-off sentiment really magnified here by the extensive red that we have on the European map this morning then, Chrissy. So as I mentioned to Kailey, sentiment just deteriorating as the longer we go through the European session. We have higher gas prices, we have a weaker euro, all that adding up to a much weaker picture for risk assets. The FTSE down by 0.6%, but that's nothing compared to the CAC down by 1.7%, the DAX down by 1.8%. That's the graphics, that's the way this looks geographically across Europe. Let's have a look at some of the key dynamics, the key players, the key assets on the move, if you like. And it doesn't matter if you price it in pounds per therm or euros per megawatt hour. We see higher gas prices across Europe today. These are the benchmarks in the UK and in Europe, and they're both on the rise. And those percentage moves are just the prices going higher today. We've already seen a 14-fold increase in German power prices now compared to the 5 years that were before this year, so pre-2022. And we are seeing now Germany thinking about using more coal, extending the life of its nuclear power plants, looking at all kinds of options to try and shore up supplies of energy. And the thing that has driven this big move today is Russia saying it needs another 3 days of maintenance on the Nord Stream pipeline at the end of this month. That once again triggers concerns about whether those taps will be turned back on. That's weighing on the euro. We dropped below parity. We're back above it now, 1.0013. But we did drop below parity, and we did have, I was reading a note earlier from Nomura talking about the possibility of blackouts during the winter in Europe, and that is obviously something that's going to weigh on the currency. I put in here one corporate story as well, Kailey, because this is of interest. This is a company that's listed in London, but just under 70% of their revenues come from the US. It also operates the Regal chain of movie theaters over in the United States. They may file for Chapter 11 bankruptcy. They're dealing with a big debt pile because of the pandemic, and also because they were about to make a bid, or they made a bid for a Canadian company that they didn't end up buying, but have a fee to pay as a result, Kailey.
Yeah, that stock was down 58% in Friday's session, which is really quite remarkable. Of course, that is what happened last week. Let's take a look forward now at what is coming this week. UK Foreign Secretary Liz Truss and former Chancellor Rishi Sunak are campaigning today in Birmingham as they vie to be the country's next prime minister. Plus, with politics here in the U.S., primary elections will be held in Florida and New York on Tuesday. Plus, retail earnings keep rolling in, with Macy's set to report results. Russia's war in Ukraine will be hitting the 6-month mark on Wednesday, if you can believe it. It has been half a year already. Then on Thursday, Kansas City Fed's annual economic policy symposium kicks off in Jackson Hole, Wyoming. Of course, we'll have live coverage from there with the surveillance team, as well as Michael McKee. And the big event will be Friday, Creedy, when Chairman Powell takes the podium in Wyoming.
And really the conversation there is all about just how much further can the Fed really hike as we start to see looser financial conditions. A completely different story across the Pacific in China. China making another attempt to alleviate the growing housing crisis and bolster borrowing demand. Chinese banks lowered lending rates while authorities stepped up support for the property market with additional loans. Enda Curran, our Bloomberg chief Asia economics correspondent, joins us now. And it's interesting to see this divergence between the United States and China right now when it comes to the policy front. How quickly could this become a dangerous move?
Well, we had two new developments today. On the one hand, banks said they will bring down their 5-year lending rates by more than expected, by 15 basis points. Clearly, that will bring mortgage rates lower. That is going in the opposite direction to the US, like you mentioned. It will, of course, perhaps help demand for loans at the margins in China. On the other side, by the way, today, the government said they will make loans available to those property developers who need finance to finish off unfinished property developments. So when you take it together, it speaks to a new urgency among the government to try and fix China's housing slump. It will add some support to that sector, but nobody's saying this is a turnaround for China's economy. More support will be needed, and it is a deepening divergence with the Federal Reserve.
And a lot of other central banks as well. Bloomberg's Enda Current, thank you so much. Of course, central banks in Europe dealing with an energy crisis as natural gas prices are surging once again on fears that planned maintenance on the Nord Stream pipeline may lead to a prolonged supply halt. Bloomberg's Danny Berger joins us now and is taking a look at the moves, which, Danny, maybe no surprise, but they're huge today.
Yeah, gigantic, and it's not the first time we've seen gigantic moves or had this fear that with the maintenance, it would be used as an excuse for Russia to completely halt that energy, that nat gas flow, or severely curtail it. Of course, it's already curtailed. So we see this big jump in nat gas futures. If you were to price Dutch front-month futures the same way you price oil, this would be the equivalent of around $500 a barrel. All of that feeds into what power prices we're paying here in Europe, and that also means record power prices in Germany, at one point jumping 20% today. Now, the German government has already talked about trying to reduce gas usage by 20% and said that if Russia stops flows, they would not have enough gas for the winter. So what does this mean? Higher prices for nat gas means industry shuts down in Germany. That means the major exporter of Europe also shuts down. That means current accounts start to deteriorate, narrow. All of that means a weaker euro. We saw the euro do just that this morning. It continues to, at one point, piercing below parity. It is just above it at this moment. Anna, you pointed it out. 10013 is where we stand on the euro. But of course, things could continue to get worse if we continue to see industry shut down in an inflation spiral that is truly out of the central bank's hands.
Right, yeah, more details there from Danny Berger. Thanks, Danny, for that. Bloomberg's Danny Berger on the energy markets and the knock-on impact on FX that is having. Now, Britain's summer has already been punctuated by scenes of travel chaos, and there's more to come. Workers at the country's largest container shipping port, Felixstowe, have joined the list of those on strike. So there's a different kind of travel for containers. For more, let's get now to Bloomberg's Lizzie Burden, who joins us from Felixstowe. This on the east coast of England then, Lizzie, a really busy port when it comes to imports from Asia. What's the latest?
Yes, Anna, this is a symbolic moment in the UK's summer of strikes because Britain's biggest container port is Felixstowe. As you can see behind me, about 4 million of those containers pass through this port every year. And so the Russell Group estimates that the 8 days of strike action are going to cost about $800 million worth of affected trade. That's electronics, clothes, furniture, all when retailers are gearing up for Christmas. Flexport says it's going to take 24 days to clear the backlog. Now, you could say, yes, shippers can reroute. Maersk has already redirected 3 ships. It's monitoring 11 more. But that's going to add to costs and time delays. Now, yes, disruption is the point of a strike. The union has rejected a pay offer that wasn't quite as high as the 10.1% CPI that we're seeing in the UK now. The port says that's too high to expect because this pay offer has to deal with the whole of 2022. Inflation's only just tipped into double digits. But the unions are making a point. It's not just the dockers at Felixstowe who are striking, it's also dockers at Liverpool, it's transport workers generally, nurses, barristers. The risk, though, is that the unions, through a wage price spiral, add to the inflation that they're trying to protect their members from.
Lizzie Burden in Felixstowe, we thank you as always for that really crucial update coming out of the UK. Let's bring it back to the States here. President Biden has spoken with European leaders looking to revive a nuclear deal with Iran. The U.S. is considering a response to Tehran's position on the latest proposal and wants to calm fears in Israel about a possible deal. That, according to Axios. Anne-Marie Hordern, our Bloomberg Washington correspondent, joins us now right here on set in New York this morning. Walk us through the details of the deal.
Well, right now, this call, we don't have a ton of details about the call. And the deal, the United States has plays their cards very close. So they're not saying what the response is going to be. All we know is that the Europeans say that it was constructive. So we still don't know how the United States is going to respond. Potentially, this call was to quell some of those concerns with Middle East allies like Israel, who are starting to panic a little bit that maybe a deal will be close. But I don't think we could say a deal is close just yet, because the Iranians were supposed to maybe sign off on this text, and it sounded like they gave responses. So it does seem like there's still a lot of negotiating to go down the line.
Well, and there's been a lot of negotiating that has happened already. They've been trying to reach a new deal for some time now, and yet it seems that the continual things standing in the way are the same things that always have, long-standing hurdles that are still there.
And Goldman Sachs says maybe just this state of negotiation in itself is mutually beneficial for both sides. The biggest issues are going to be what the Iranians want is the U.S. to put this ironclad, that if a new administration comes in, if it's Republican, they cannot withdraw. And Mohammad Morandi, this Iranian who's on the nuclear deal talks, says that the U.S. needs to pay a price if they pull out. So they want to make it really difficult for the United States to pull out. The other big hurdle that has always been in the way, but there's been reports that potentially Iran has started to back away from that, is that the Islamic Revolutionary Guard be taken off the terror list. Maybe they've capitulated on that, but they certainly have not capitulated on the fact that they want this to be legal text. So say there's a Republican president, they can't withdraw the way the former president did in 2018.
Okay, yeah, the extent to which you can bind a future administration. Really interesting point there. Bloomberg's Anne-Marie, thank you very much for the update. Now it is the first big leadership shuffle at Credit Suisse under the new CEO, Ulrich Körner. He's named Deutsche Bank's treasurer, Dixit Joshi, as CFO, and Francesca McDonough has been promoted to operating chief. Körner is trying to turn around Credit Suisse and has promised a restructuring plan for the investment bank by November. Tom Metcalf joins us, Bloomberg finance editor. Tom, what can we read into these changes? It's not the first management reshuffle we've seen at Credit Suisse in recent years.
No, but really interesting, and I think particularly the appointment of the CFO is a bit of a coup for the bank. So very well regarded, and I'm sure they're probably quite happy as someone sort of seen as a safe pair of hands they're able to bring in. And the other point from the reshuffle is Francesca McDonough, as you say. She hasn't even started at the bank. She's already been promoted, so now she's COO.
Was at Bank of Ireland, of course. Talked to her many times in
exactly.
role.
So I think, they're looking to tap that experience, and what's interesting there perhaps is, hey, she is mainly a retail wealth banker by experience. So that's a good sign, again, of where they're looking to focus their attention on.
Tom, what about the investment bank? Has there been any impact on the plans there?
Yeah, we had a really interesting deep dive on sort of the what they're likely to do to it. And I think these appointments won't really impact those plans, which are basically really strip it back, go to advisory-led, cut back on the capital use. So I think, that's going to be led really by the CEO and the chairman. So I think these new appointments are much more in terms of, again, a strong bench of executives in place and hopefully, again, reassuring investors on the sort of retail wealth side of things.
Tom, all right, thank you very much.
Indeed. Thank you. And of course, we'll have more, Anna, on that Credit Suisse story. It is the topic of our latest big take as investment bankers expect to draw a dramatic shrinking of their business. So we will be discussing that later this hour. And of course, you can find that on the terminal and on Bloomberg.com. Meanwhile, one other story that caught my eye today, the debut of the prequel to Game of Thrones overwhelms the HBO Max streaming service in the U.S. More than 3,000 outages were reported across the global monitoring service Down Detector at 9 p.m. New York time, just as House of the Dragon was released. The new series premiered more than 3 years after the last episode of Game of Thrones, which drew more than 19 million viewers. I have to say, I myself was one of them. I loved that show. But let's see how that's translating into pre-market trading for Warner Brothers Discovery in early hours. It is down, though it is not necessarily underperforming the broader market, given that futures are pretty dramatically lower today. It's down by about 1%. It is a much bigger decline, though, for one of the favorite meme stocks that maybe is no more, as we're seeing some deflation of that trade. AMC is down 35% in early hours, though that in part may be due to the fact that its preferred stock, APE, is going to be trading on the New York Stock Exchange starting today. And it is a big move higher for one company, Signify. This is a home health company, and Bloomberg reporting overnight that bidders potentially for the company include United Health as well as Amazon. United Health, according to our reporting, set to offer a little more than $30 a share. Amazon's offer apparently pretty close to that, maybe just below. But as a result, the stock is trading at $28.50 a share, up about 34% before the bell, Anna.
Certainly one to watch then, Kailey. Coming up on the programme, Freya Beamish joins us, head of macro research at TS Lombard. What does she make of inflationary pressures around the world? This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. We're simulcast on TV and radio. Let's talk about one of the hot topics this week. It's going to be all about the Federal Reserve. Big surprise there. But it's also going to be about what they're going to do about financial conditions. Remember, we have actually seen financial conditions tighten quite a bit since the start of the war in Ukraine. For our TV audience, you can see the chart. For our radio audience, what you need to know really is financial conditions have tightened more and more until July. You saw this massive reversal in the stock market where you did actually see it actually pushing financial conditions higher. Remember, a weaker dollar has also played into that story. The question is, how much room does it actually give the Federal Reserve? Do they really need to do anything about it? Or is the market actually readjusting and really assimilating to the new market dynamics? Let's ask Phil Serafino, a senior markets editor for Bloomberg. He joins us now from Paris. Phil, what do you make of all this?
You know, you have to think that the Fed probably doesn't want to see financial conditions getting looser going into the fall. You know, their goal is to cool the economy down, and the stock market, frankly, is pricing in good times ahead. You know, investors are assuming the Fed is going to succeed in cooling inflation, slowing the economy a little bit, but not tipping it into a recession. If you look at the market since mid-June when it started rallying, all 11 sectors of the S&P 500 are up. Consumer discretionary stocks are leading the way. That's like autos, retailers, casinos, hotels. That doesn't sound like a cooling economy. So, you know, the financial conditions are saying, hey, things aren't so bad. And the Fed definitely wants to cool things down a little bit.
Phil, good morning. Does that mean we are expecting, well, we're primed for good news and could be wrong-footed by bad news? And we'll have some key data points out from the US, of course, in early September.
Yeah, absolutely. I mean, the market is assuming, again, that everything goes just right. And the Fed, I think, has been pretty clear that they'll do what's necessary to cool inflation. Investors over the past couple months, though, have looked at every economic point, every statement by the Fed, and assumed the best possible outcome, that the Fed won't go too far. So, you know, you've got Jackson Hole, Jay Powell on Friday might want to send a message. And then, as you said, in early September, we've got the jobs report in the U.S. and CPI data coming in the middle of the month before the Fed meeting later in the month. So, I mean, there's a lot riding on those data points for the market.
Phil, thanks very much for the update. Bloomberg's Phil Serafino there with the latest on market moves ahead of Jackson Hole and the speech we're going to get from Jerome Powell there. For more on the market, for analysis, check out MLIV Go on your Bloomberg terminal. That is the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now, keeping you up to date with news from around the world, here's the first word. Since the start of the war in Ukraine, China has increased its purchases of energy from Russia. According to the latest customs figures, spending on oil, coal, and gas has risen from $20 billion a year ago to $35 billion. That increase comes as other countries shun Russian goods as punishment for the invasion. Meanwhile, Germany may have to extend its use of nuclear power if it's not able to replace all of its imports of Russian natural gas this winter. Berlin had decided to exit atomic energy permanently by the end of the year, but Chancellor Olaf Scholz and Economy Minister Robert Habeck said that there's the option of extending the lives of Germany's last 3 reactors past December. The U.S. and South Korea have begun their biggest joint military exercise in about 5 years. That's after taking a break on large-scale drills failed to lead to North Korea's Kim Jong-un to make concessions in disarmament talks. The exercise will involve thousands of troops and will stimulate a response to an invasion from North Korea. In the UK, Rishi Sunak has told the frontrunner to be the next prime minister that she has a choice to make. Sunak says Liz Truss can either deliver support for struggling British households this winter, or she can stick to her policy of tax cuts. He is pledging for more direct aid. And of course, Anna, it's a tough picture for fiscal policymakers in the UK and monetary policymakers as well.
Yeah, absolutely. The fiscal focus not made any easier by the fact that we are witnessing a leadership context and the decision still to be made about who becomes the next UK Prime Minister. Coming up, we'll talk about global macro. Freya Beamish joins us from TS Lombard. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. China tries to fix a worsening housing crisis. Banks lower their benchmark lending rates while the government steps up support for the property sector. Walkout. 2,000 dock workers began an 8-day strike at the UK's busiest port for container ships. They rejected a contract offer as inadequate. And a shake-up at Credit Suisse. There will be a new CFO and operations chief. All this as the Swiss lender prepares for a major restructuring of its struggling investment bank. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz in New York. Matt Miller is off today. Kriti, US futures then under pressure. European stocks, risk assets more broadly under pressure. Higher energy costs here in Europe, the focus. What's in focus ahead of the US Open?
Yeah, well, it seems like pulling out of the stock market, or at least equities as an asset class, is really the story globally. And you can see that really right at the top, Anna, as you mentioned, the future story down 1.2% in pre-market trading, even yields kind of unchanged, even though you did see some intraday volatility earlier in the Asian session. But I really think the dollar is the story here, because remember, those inverse correlations that you see between the dollar and the commodity space is also just as strong in dollar versus the stock space. And that seems to be the theme as well. Bloomberg Dollar Index up about 0.2%. But once again, it really is that risk-off story that you can even see in Bitcoin futures down 1.5%, Kailey.
Yeah, and a lot of declines for Bitcoin over Friday and Saturday as well. So perhaps no surprise, crypto-related equities aren't doing so well in pre-market trading today. The likes of Marathon Digital and Coinbase, the big crypto exchange, are each lower in the ballpark of 3 to 4%. You're also seeing some air come out of other speculative areas of the equity market, like those meme stocks, including AMC, which actually its preferred stock, APE, will begin trading on the New York Stock Exchange today. So that in part may be what is weighing heavily on the shares this morning, down 34% before the bell. And of course, for Bed Bath & Beyond, which caught all of our attention in recent weeks, it fell 50% between Thursday and Friday. It is adding to those losses today, down nearly 10% before the bell, Anna.
Kailey, European stocks under pressure today. We've got weakness across European equity markets. There we go. Stocks Europe 600 down by 1.2%. In particular, France and Paris of the major markets coming under some pressure. And a lot of this has to do with higher energy prices. This is the European benchmark in euros per megawatt hour, 14.5% higher. And that is just in today's trading. The catalyst for this, Russia saying it needs to do another 3 days of maintenance on that one turbine that's functioning through the Nord Stream pipeline. So that will happen at the end of this month. That raises questions about whether flows get turned back on. We're back to having that conversation again. And so Germany searches for alternatives in the meantime. The euro is responding to the same story. We went below parity briefly a little bit earlier on, an hour or so ago, but now at 1.0005, 0.3% weaker for the euro against the US dollar. Are we going to be talking, in the words of Nomura, are we going to be talking about blackouts around Europe periodically over the winter? And that's going to be something that will weigh on the currency perhaps. Cineworld is a London-listed operator of cinemas or movie theatres. It operates the Regal chain over in the United States. Nearly 70% of revenues come from the US, and they've said today that they may seek Chapter 11 bankruptcy. Kailey, you reminded me, of course, that on Friday we saw a really big drop in the share price here of this company, now sort of bouncing back a little bit from some of that, some of those losses on Friday, but absolutely not making up for those losses on Friday, up by 2.7% today.
Yeah, it doesn't go too far to erase the 58% decline of Friday, but at least it's something, Anna. All right, let's turn back to the broader global economy now. As we await Jackson Hole later on this week, one question seems to be on everyone's minds. Is a recession necessary to rein in inflation? That, of course, is the question from our MLive Pulse survey. Here is how people have responded.
This likely recession that we're heading into is largely supply-driven, supply shortages.
Recession certainly is a potential cure for inflation.
The medicine is probably supply-side related. Supply problems require supply solutions, not something that monetary policy is apt. And so driving a recession is really a poor and suboptimal outcome.
There's no need for central banks to ram a recession down the throat of economies that simply do not need rates to be moving higher.
We just need a period of absorbing and also allowing some of those mechanisms to work its way through.
I actually think the U.S. economy can withstand much higher interest rates than I think people give it credit for.
Joining us now to add her voice to that chorus is Freya Beamish, head of macro research at TS Lombard. So, Freya, what do you say? Is a recession required?
Funny, we're almost back to asking that same question that was asked of Margaret Thatcher in the 70s, and her answer was unequivocally the TINA, the original TINA. There is no alternative to a recession to cure inflation. I'd probably add a clause to that, which is if your politicians are not able to deal with the problem through more targeted fiscal spending and taxation, then a recession is necessary to cure inflation. And that's exactly what we see. So the buck gets passed to the central bankers across developed markets, and central bankers have very blunt tools, and therefore it is more likely that you get a recession. But I think there's a slightly flippant answer. If we really look at the dilemma that policymakers and central bankers are facing, it's not one that you want to foist upon anyone, and it's this type of propensity. If I look at it through the credit prism, I think it becomes clearer, because you do have a need for central bankers to break spirals. If you think of inflation being very high, and therefore real interest rates are very low, and therefore credit demand is perpetuated at a higher growth rate, and that keeps this demand-supply imbalance running, and therefore inflation keeps running, and therefore the real interest rate is not sufficiently constraining. It takes the central bank, in some cases, to step in and raise real interest rates to a level that is constraining, and a recession tends to follow that. So when we get to kind of, go ahead, sorry.
Yeah. No, so a recession tends to follow that. Your view, Freya. You also talk in your notes ahead of our conversation about a mirage of disinflation. So disinflation being a reduced level of inflation, but still seeing price rises year over year, so still seeing inflation. What kind of levels will we disinflate to, do you think, Freya, and why will it be a mirage?
I think what's the key metrics that we're looking to is the core of inflation, and almost the core of inflation. You start to exclude everything, there's nothing left, but that kind of the part of the basket that's driven by wages. Broadly speaking, to give you the numbers, the core inflation rate that we're looking at by sort of Q2 of next year is around 3.5%, with significant risks on either side of that. But the narrative, once we get past this terminal rate for the Fed funds rate, is going to switch to this disinflation story, which has been very much driven by commodities. So if I put that in the bigger context, the bigger picture context of the 2020s, it's almost like a sort of a hawkish sandwich around this mirage of disinflation that we see starting to dominate the narrative in 2023. So in the short term, we see the Fed funds rate will probably have to peak somewhat higher than is currently expected by markets. And then you get this disinflation mirage starting to dominate the narrative, but that really only gives you a better entry point for the reality of the remainder of the 2020s, which we think is that there will be higher inflation on average over that period than there was over the 2010s. And in the case of the US and maybe even the euro area, you probably get a bit higher growth as well. The implication of that being higher yields, Fed acceptance of higher wage growth and therefore a steeper curve, but also lower valuations go hand in hand with that as well. So there has to be some kind of a market capitulation as it becomes clear that this mirage of disinflation is in fact a mirage as you move through from 23 into 24. And you get the final kind of reckoning that inflation is actually going to settle higher than the post-global financial crisis cycle.
Freya, at the beginning of the segment, you made a Margaret Thatcher reference that I absolutely adore. Let's stick with that time frame here, because so many parallels have been made in terms of the energy story of now to the energy story of the 70s. I'm curious of what follows. Are we in for an 80s-like dynamic?
This is one of the reasons why we think inflation is going to be higher and not in a benign way. So most of the time you think inflation, it's just an out and out bad thing. Some inflation, where it redirects income towards the household sector, might actually then somehow cause higher growth. So it's not necessarily a bad thing from a real economy perspective, although it does have a negative connotation for valuations. But what's more outright negative, coming back to your question, is the threat of continued supply shocks. And it certainly seems like we've deteriorated in terms of the geopolitical backdrop. If we look at the Cape, and this is really analysis that my predecessor at TS Lombard, Charles Dumas, put together. If we look at cyclically adjusted PE ratios, they do actually mean revert over geopolitical periods. So over the post-1989 fall of the Berlin Wall period, we have cyclically adjusted PE ratios in the region of 25. In the short 20th century, where you did have the Cold War and you had more of these supply-side driven shocks in that period, you also had 2 world wars. So hopefully not going back to a 13 cyclically adjusted PE ratio as we did in that period. But the presence of those shocks on the supply side is likely to be more prevalent. Okay. We can't say when they're going to happen, but that does pose a threat in terms of cost push inflation and a deterioration of valuations.
With that in mind, then, should we expect mean reversion, Freya? Are we in a different era now?
I think we are. I think we're entering an era where we're in a kind of a containment 2.0. We've got a greater threat of supply side shocks from that side. We've also got a greater threat of supply side shocks from climate crisis and the actual move towards net zero itself, whereby resources are used in order to reduce greenhouse gas emissions, but not necessarily to expand the productive capacity of the capital stock. And therefore, that's an inflationary environment as well. So all of these things point to greater kind of cost push inflation, which is more kind of stagflationary, with the saving grace that I do think that there are shifts in the global labor market, which will allow developed market wage growth to return in a way that it just was not present in the period since China joined the WTO in 2001, and that will entail a rebalancing, a positive rebalancing in growth terms. So that's the sort of saving grace from the real economy perspective, which means that we should be trying to get exposure to the tangible side.
Freya, thanks so much. Thanks for joining us. Freya Beamish of TS Lombard with us with thoughts on inflation. Coming up on this programme, we'll get back to the banking sector and the latest news flow there. Credit Suisse is bracing for a brutal carve-up of its investment bank. More from today's big tech story next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Peter Trubowitz, London School of Economics Professor of International Relations. That's at 6:30 a.m. in New York, 11:30 a.m. in London. This is Bloomberg.
The last 10 years certainly have been bad, very bad for the bank, but you look at the situation today, trades at less than a third of book value. Yeah. It still has a robust private wealth business. All they have to do is prevent the investment bank from losing money and get it back to some sort of growth.
That's no small task. David Harrow of Harris Associates speaking with Bloomberg TV on Friday. Meanwhile, Credit Suisse has continued its shakeup of top management, introducing Deutsche Bank's Dixit Joshi as its new CFO while promoting a new chief operating officer. And today's big take focuses on the Swiss lender's emergency restructuring, which will likely deliver deep cuts, potentially signaling the end of the lender's ambitions to be a Wall Street titan. Shonali Bosick, our global finance correspondent, joins us now. So, Shonali, let's first start with the leadership changes we've learned about in the last 24 hours. How does the new CFO kind of fit into the bigger picture here?
Yeah, it's a huge story because Dixit Joshi, this is a homecoming of sorts. He was at Credit Suisse First Boston at some point, and more importantly, he was at Deutsche Bank during its massive transformation. There are a lot of parallels between what happened at Deutsche Bank and what's now happening at Credit Suisse. So what does that entail? Job cuts being one of them, facing higher costs of capital, facing credit rating cuts. All of these things are a difficult thing to navigate, let alone in the middle of a lot of global turmoil and a war in Europe. So this is somebody who has been through it before when it comes to a massive restructuring. Remember, Deutsche Bank had to sell some of its assets. They had to get out of equities trading in a larger way. They had to make a massive headcount reduction, almost a fifth at the time they announced. And so this time around, he is somebody that is being looked on to really navigate those similar changes at Credit Suisse. It will depend on how deep they end up cutting.
Well, let's bring it back to the investment bank here, because you've been very vocal, I want to say at least on my show or later in the day, but throughout the day, about how deal volume has fallen off of a cliff. Why is Credit Suisse seemingly a little bit more vulnerable or more exposed to that story than its competitors?
Well, for two reasons. Credit Suisse is actually a massive equity underwriter. They were a huge SPAC underwriter last year, and they're also really big in Asia. Of course, Asia has also been under pressure, and the SPAC market has been pretty non-existent this year. So they're in businesses that have been pressured, as well as leverage finance, huge leverage finance underwriter, and that is another business where they've had to take some losses. But if you look at Credit Suisse, they're actually still a top 10 U.S. M&A advisor, or a global M&A advisor. They were on mega deals, Broadcom, Intercontinental Exchange. And so the question is, can they sustain that with a lot of brain drain they've had and compensation costs they want to keep under control? Interestingly about the investment bank is they made more money in revenue at the investment bank in the first half of this year, but they lost a lot more money, partially because of compensation expenses and partially because of litigation expenses. We already know about Archegos, and partially because of those mark-to-markets that I've been talking about.
And Sonali, so a lot of issues that the investment bank has come up against of late, and a lot of issues still to deal with there. So what kind of investment bank can we expect at Credit Suisse after we've seen all of this upheaval? What does our reporting suggest?
Well, this is what's amazing about the big take that's in Bloomberg today, is that there's not a firm agreement yet on what that looks like. On one hand, you have investment banking being a bit of a ballast when wealth management is also under pressure. However, this is a much more capital-intensive business, especially because Credit Suisse is so big in fixed income and some of those riskier areas that I had been talking about. So tough decisions to be made here. Do they keep parts of the investment bank? And most likely they will keep the parts of the investment bank that serve the wealth management unit the best. Wealthy individuals do M&A deals. They do want to engage in trading. And so how do they right-size that business? Again, kind of similar to what we saw at Deutsche Bank. Do they sell assets? Do they let go of some more staff? And how deep, again, does that cut get?
With all of the questions that are out there, as well as attempts to pull back on costs through compensation, how are they supposed to retain talent?
That's a great question, because we have seen a brain drain for the last couple of years. I have to say something interesting, even though the most recent challenges at Credit Suisse are severe. They certainly are. Remember, they are trading at about a third of book value or less, depending on when you look at it. But they've had a long history of volatility at this investment bank. That's what makes this story so remarkable. Anybody that had any point of contact from Credit Suisse from the first Boston days to 2015 to 2017, when they lost a third of their share at that time. 2018, they still had an ambition to be top 5 in equities trading. They were hiring from Bank of America, from Goldman Sachs. That was just before the pandemic. So
how quickly things change.
How quickly things change. And I think that's what any of the major investment bankers here are saying. Let's not be fickle here. Let's take the longer term view while still paying attention to the fact that this is a capital intensive business. Let's see if we can make it more capital light.
Sonali, thanks very much. Bloomberg's Sonali Basak there with the latest on Credit Suisse. And if you want to read more about that big take story that she referenced, you can do that on Bloomberg.com or by typing NI Big Take into your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kruti Gupta in New York and Anna Edwards in London. Matt Miller is off today. But very much in today, Tom Keene, co-anchor of Bloomberg Surveillance, who is joining us now. Tom, what's your single best chart for a Monday morning?
Well, the headline's euro through parity, but it's also a weaker sterling as well. We had a 117 handle on sterling, really showing the energy issues and the difficult war news over the weekend. And I thought I'd take a look at the animal spirit of the United Kingdom. I was shocked at the chart. I really didn't know what to expect. And there it was, the flatlining of the United Kingdom economy in U.S. dollars since 2007. The red circle is the great financial crisis. Down it goes with some real nominal GDP challenge. The 4-year moving average shows the flat line with a little bit of good news recently based on U.S. dollar, but a really distressing chart. If you extrapolate out what the British felt years ago, we now have a 78% shortfall in what used to be the United Kingdom economy. And you go, well, how can that be? And the answer is it was 15 years of malaise that we're dealing with. The length of time is extraordinary.
Yeah, still not really seeing the recovery in some metrics since the financial crisis. So that's one of the things dominating your coverage. Thoughts, of course, on the euro, as you mentioned. Which guests do you have in store to cover these stories?
Well, we've got a lot coming up here to readjust to the market. And, of course, I have David Costin's note of Goldman Sachs over the weekend. Lori Calvasina will be with us with RBC Capital Markets. A very acute weekend note, as always. And far, far more importantly, we're going to begin to get ready for Jackson Hole. Peter Trubowitz of LSE will join on all going on in Ukraine. And very importantly, Leland Miller will give us an update with his really acute analysis of China. That's one of the things I'm sure that Jerome Powell will consider on our road to Jackson Hole.
Absolutely, as we saw more stimulus there overnight. Tom Keene, looking forward to the next 3 hours of coverage. Thank you so much. Now, as for what else we're looking forward to today, I will be watching for Zoom video earnings after the bell, something, of course, we all got familiar with over the course of the pandemic. But now that more people are back in the office, how is their business really doing, especially if you have businesses pulling back on spending due to a softer macroeconomic environment? The shares are already down 46% year to date. They are hovering around pre-pandemic levels. So could earnings change the trajectory? The Street is expecting sales growth of just 9% year on year, which would be an all-time low. So something to keep an eye on after the bell today, Creedy.
Well, certainly something to keep an eye on as I want to not make a pun here, but zoom out and look at broader markets here. Of course, we are seeing them under pressure. I had to do it. I had to. You're looking at the broader markets under pressure as well. And of course, the concern here is, do you start to see that bear market idea come back into the picture, Anna? We really don't know. Of course, we know there has been some momentum in the stock market recently, but how much of that is really just a question of summer volume and how much of that is really sustainable?
Yeah, certainly coming back after a little bit of time off, those questions around whether that summer rally can be sustained. Well, it certainly looks more doubtful, doesn't it? Today's sentiment pretty weak. Let's have a look at what's going on in the UK then. I'm focused in on the UK strike activity. You know, this week it's Felixstowe Port. Other weeks it's been other parts of the economy, rail, mail services, criminal trial lawyers and the like. But today we're talking about an 8-day strike at Felixstowe, the biggest container port in the UK. So this is going to have some significance. Clothing, furniture, all kinds of stuff from Asia in particular comes through the Felixstowe port on the east coast of England. We spoke with the union boss on radio who's actually negotiating this, and they've rejected a 7% plus £500 one-off payment. They're looking for something that is more like RPI, a different measure of inflation in the UK, which currently stands at 12.3%. Could there be some room for compromise between the two? That seems to be the summer, the autumn, the fall, the winter perhaps that we're talking about here, those kinds of pay discussions. That is it for the early edition. More surveillance is ahead with Tom, John and Lisa. They have a packed lineup as they build towards that Jackson Hole symposium a little bit later this week. This is Bloomberg.